This is a presentation on investing. This includes the 5 stages, the risks, return, and liquidity that presides with each stage. Risk, return, and liquidity. Each stage of investing has varying risk, return, and liquidation levels. With risk, ask yourself, how high is the chance of losing my money? If something is of high risk, then there is a larger chance of losing your money than if an investment is low. Risk and return balance each other out, although it is unlikely that a low-risk investment will ever get you a high return. Return, how much will I get back, or what are the interest rates? Depending on your risk of how much money you put in and whether it will soar or fall to the ground, your return follows. The higher the risk, the greater chance of a larger return of sums of cash. However, a larger risk of losing your money if it fails. Liquidity is how easily you can get your hands on your money. It has nothing to do with any sort of liquids, only the fluidness of cashing in. Is getting your money like climbing over a chain link fence with only the risk of a scratch or two, or is it like trying to get through a 10-foot brick wall? That is liquidity. Now, risk comes in 3 general levels. A low-risk investment is something that you are very unlikely to lose your money in and can easily get your cash back into your hands. An example would be a savings account. Your money is relatively safe and is easily accessible, but comes with little return of interest. A moderate risk investment would be investing like a large cap company such as General Electric or Microsoft. There is more risk to these than your average bank account, but your return is also more likely to go up because these large cap companies' shares are most likely to go up in value. Getting a hold of your money is not too hard, yet will take more time as these stocks are constantly changing. A high-risk investment is one where there is either a large percentage chance of loss of capital or a relatively small chance of a devastating loss. The first of these is intuitive, if subjective. If you're told there's a 50-50 chance that your investment won't earn your expected return, you may find that quite risky. If you're told that there's a 95% chance that the investment will not earn your expected return, then it is agreeable that that is quite risky. One of these high-risk investments includes penny stocks. A penny stock is one that trades at a relatively low price and market capitalization, usually outside of the major market exchanges. These type of stocks are generally considered to be highly speculative and high risk because of their lack of liquidity and large bid askings. The typical penny stock is a very small company with highly illiquid and speculative shares. Other examples of high risk investments companies would be Mercury Insurance Group, Lehigh Gas Partners, or You Invest. Now we get into the 5 stages of investing. These include put and take account, beginning to invest, systematic investing, strategic investing, and finally speculative investing. Beginning to invest. Here's where you move up a step from a simple savings or checking account. It's time to think about beginning to invest where it really counts, like mutual funds or bonds. By purchasing, put and take account. This is the simplest of investments. These include checkings or savings accounts. The risk of losing your money is extremely low. Along with that, the return is once again extremely low too. The average interest rate on a savings account is 0.06%, but the liquidity is so good that you can count on getting your cash in your hand when wanted. Now, here's where you move up a step from a simple savings or checking account. It's time to think about beginning to invest where it really counts, like mutual funds or bonds. By purchasing mutual funds, you're provided with the immediate benefit of instant diversification without the large amounts of cash needed to create individual portfolios. Another advantage of mutual funds is the ability to get your money in and out with relative ease. There is very little risk, although your money is not going to soar into infinite blissful amounts. And because there is a low risk, the returns are not so great either, but heck of a lot better than 0.06 return like in a savings account. In a mutual fund, an investor puts money into said funds, which is then invested into securities, which creates an increase or more money in returns that is given back to the investor, and the cycle starts all over again. Systematic investing ties in with the beginning to invest slide. Now that you have your mutual fund stocks or bonds, you want to be planning for long-range funds and keep them spread out. For example, putting some assets in bonds and other assets in stocks can reduce the risk because an interest rate shift that makes bonds less valuable will tend to make stocks more valuable and vice versa. The risk is moderate because you're branching out on where you're putting your money, and corporate bonds are riskier than a savings account. The return is so-so since you will get more back, but it's not very liquid because to get more money, you have to let time take its course. Bonds need to be held usually for at least 10 years. Otherwise, if you cash them in earlier than the set time period, you could be forced to pay a penalty fine. Strategic investing is just as it's titled. Don't put all your eggs in one basket. Keep your shares diversified so that if one fails, hopefully the others can balance out those losses. It's still a good idea to have assets in both stocks and bonds since they balance each other out fairly well out. The risk is moderate, but you need to keep a close eye on your stocks, unlike not having to worry about your savings account security. The returns are definitely good if you do your homework on the stocks you invest in. Stocks are actually more liquid than not, but sometimes you have to wait certain periods of time to buy or sell specific stocks. The last step is speculative investing. This is where most people aren't steadfast on whether their finances could handle the ups and downs of high-risk investments. These include things like real estate or gold investing. The risks are very high. Depending on how well the investment does, your returns can be enormous, or you can actually lose all of your assets. That's why most people stay out of these high-risk investments. These investments are pretty illiquid. Illiquid assets cannot be sold quickly because of a lack of ready and willing investors or speculators to purchase said assets.